Joining me right now, we want to talk a little bit about what is real inflation, what's going on here. And David McIlvaney joins me. He's the CEO of McIlvaney Financial Group. Good morning, David. Welcome back to the program.
Good morning, Bill. Good to be with you.
All right, great to talk with you again here, too. Interesting stats that inflation may be starting to bite and hurt a little more than we've seen for a while. You want to kind of set the table?
Well, sure. The issue is we've been understating inflation for a long period of time. And if you go back to the 1980s, there's been a number of changes in the way that statistic is calculated. And the real benefit has gone to government. Now, I mean, granted, we've got a major fiscal disaster here in the United States. We can't manage our own household. But the fact is, Senate, in recent discussions, is talking about moving to an even different measure of inflation. This is the chained versus unchained consumer price index argument. And what they're trying to do is save themselves tens of billions of dollars per year in not having to adjust Social Security payments according to the cost of living adjustment. In other words, they're basically cheating retirees out of those tens of billions of dollars, trying to make the argument that it is, in fact, an overstated statistic versus the position that we would take is, in fact, it's understated by a minimum of 2%. If you went back to how inflation was calculated in the 80s, late 70s, we're nearly double-digit.
We're nearly double-digit inflation. I know that, John Williams over at Shadow Stats has made a career out of doing that kind of counting, too. And he was talking about very close to 10%. I guess he uses 1990 methodology. And so I guess the point being, what is chained inflation? What is the difference between the two so we can understand that? Chained inflation?
The real issue here is, do you have a constant basket of goods and services that people are using? Because the CPI was originally designed to reflect a constant standard of living.
Oh.
So what is your standard of living at this point in time? And we don't want to see it reduced. Therefore, the CPI needs to reflect this constant standard of living. Well, constant standard of living would basically be a fixed basket of goods and services that your lifestyle revolves around. Now they have a basket that is constantly changing. It has nothing to do with a constant standard of living. It's basically whatever is convenient. And so if there's variables that continue to rise, you can take those out. Obviously, food and fuel are the big two that get taken out. But the primary issue here is that they can even on a seasonal basis conveniently take out major components like housing, substitute rent, and go back and forth basically to paint the number that they need to paint. I think, Bill, this is where it becomes very important for investors to understand what are the consequences, not just for retirees, but when we look at the print for gross domestic product, if you understate inflation, you end up overstating your gross domestic product figures because, again, that's one of the numbers that's factored in, the quote-unquote deflator.
So if they say that we have 2.4% GDP growth, but inflation is actually a couple percent or 3% higher than what the government states, then effectively we haven't grown at all, right?
You may in fact have negative growth. So, I mean, that's how important the statistic is. You can have this perception of normalcy in the economy on the basis of an understated inflation rate. So not only do they save themselves tens of billions of dollars, but they end up printing something that from a PR standpoint really helps you feel better about the economy. And then there is that nagging frustration where Americans across the country say to themselves, it doesn't feel like recovery. I don't see it. And frankly, I feel more inflation with every expense that I pay. What's the disconnect here? And so I think the common man is experiencing that disconnect, and the statisticians are saying, no, it's an aberration. You don't understand. There is no inflation. Nothing to worry about. Just move along.
So, David, this is the way that government is able to steal more effectively from people by the inflation, the printing of currency, the QE, and all the rest of it without people at least seeing it overtly. Fair enough?
Bill, you've hit the nail on the head. You've hit the nail on the head because, ultimately when you look at our stock of liabilities, short-term stuff is close to $17 trillion. If you look at Medicare, Medicaid, Social Security, we have, on Larry Kotlikoff, he's a professor at Boston University, his count close to $200 trillion in long-term liabilities. These are numbers that we cannot pay off, and so the unstated strategy is if you run a higher rate of inflation, you will be paying off your debts, you'll be paying off your liabilities with cheaper money. Mm-hmm. Obviously, if you're a creditor, that's not of interest to you because you want to be paid off with the full value of the money that you loaned to the debtor. So yes, it's a form of theft, just as you've described. It is stealing, and there's a variety of ways that they're doing that today. Inflation is one. Keeping rates at a very low level is another. And this is what investors are facing. This is what Americans are facing. A great heist, but obviously it's billed as something else.
So I guess what I'm looking at here is. So this is the deal. Are we really having a war right now, David, just to save the perceived trust in the system? And I'm wondering if that is why they are doing all this managing. Because if inflation was stated correctly, which would mean that interest rates would have to be above that, just to cover that. The nation's fiscal health. I mean, the plates all fall down and start breaking right around.
Well,
I mean, they no longer spin. They're trying to save the system, the Western welfare state, right?
Well, and that's where, pragmatically you say, well, I'd like to see truth and honesty in government statistics, but we are so far gone from a fiscal standpoint that if there was truth in those statistics, you would see dollar declines that no one would appreciate. You would see an interest rate increase that no one would appreciate. Keep in mind, the interest component on the national debt today is about $224 billion. That's interest-only payments on the national debt, $224. If we saw even 1 or 2 percentage points, basically for every 1% increase in the interest rate, you're adding another $165 billion in interest payments. So it doesn't take very much for you to say, wait a minute, what we have in tax revenues is going to largely be going to paying interest on the national debt. So obviously, this is a very real threat to the United States as we know it, the dollar as we know it, its position as the reserve currency in the global monetary system. So there's a lot of things that change if we actually sort of peek behind the screen, so to say, with the Wizard of Oz in theaters today. Who's really behind the screen? Well, they don't really need you or want you to know.
All right, David McAlvany, once again. He is the CEO of McAlvany Financial Group. The website, by the way, is McAlvany.com. What does this mean, what you describe here? Because we're even seeing the official government inflation statistics really spike, and spike seriously. And these are the managed statistics. What does this mean, then, for people who are trying to provide for themselves in the future?
Well, what it means for most people, what we're seeing is a gradual migration of awareness. People who are seeing something that, again, it starts at the level of instinct, saying something's not quite right. It's not adding up. I know that my bills are a lot more than they were, and I've even had an increase in income, and it's just not keeping up. What you end up seeing at the level of investors is a migration out of dollars, out of cash, and into real things. And we see that in India. They'll have a 10% rate of inflation in India this year. Mm-hmm. No surprise whatsoever that demand for physical gold and silver in India is skyrocketing. Same thing because of the intense central bank money printing in China. We're seeing a tremendous amount of investor interest in gold and silver in China. I think we'll begin to see that migration here in the United States as people, again, go from the camp of saying the government has everything well under control to something's not quite right. And if I'm not protecting my own assets, no one is. And, that's where I think people begin to feel like they're in the crosshairs and don't have to remain there.
Okay, so let me ask you, though, how it sounds then that you are a gold and silver bull. I know that you are a precious metals brokerage, and you also are a money management firm, so it is part of what you do. But how can you be a gold bull right now with as sleepy as the precious metal markets have been for several months? And as a matter of fact, it looks like a great place to stick your money in and lose for the moment.
Right, Bill, this is actually sort of the greatest contrary indicator. We've been through 5 periods of consolidation, in other words, the price dropping like this in the last 12 years. Now, gold and silver have moved anywhere from 500 to 700% higher over this 12-year period. And yet we have had these periods of consolidation where the price is doing nothing. Roll the clock back to September 2011 when the price was screaming higher. that spring, we had silver close to $50. We had gold put in new highs at $1,920 an ounce, and you had 34%. This is a Rasmussen poll, Gallup poll. 34% of those polled saying the best long-term investment is gold. Now, fast forward. What do you think?
Now, you're saying though, with that caveat, long-term, right?
Well, no. The interesting thing is that sentiment moves with the price. So everyone was interested in gold when the price was moving up. Now it's less than 5%. I mean, you have no interest at all.
Right.
And this is, I mean, classically, when you are investing in any asset, you buy low and sell high. Try not to follow the crowd. The crowd today would say, we love equities. Look at the Dow at 14.5. You've got to be in. If you're not in, it's not too late. In fact, I'm sure you saw the interview with Bernanke, and the question was asked, is it too late to be buying stocks?
Yes, it's too late. I saw that. It's kind of like saying, Ben, are you going to bless me with more inflation so the stocks go higher, right?
Right, and I think that's where, as a contrary indicator, you say, well, where is the crowd moving? If you can begin to think as a contrarian, something of a maverick, you will find great values in unpopular assets. And I mean, it doesn't matter what it is. It could be tech stocks. It could be Apple today, not at 700, but closer to 400. I mean, the question is, why are you investing? Is there fundamentals supporting the investment thematic that you're interested in? And is it bombed out? In other words, is everyone following that trend, or has everyone abandoned it utterly? And I think you're at that place where you have extreme abandonment in precious metals. That's a positive in our mind in terms of being a contrary indicator. Our view is that we finish the year with new highs, taking out the 1920 level in gold. Potentially silver follows next year, but we would be very interested at these levels.
Now, gold has been the canary in the coal mine for inflation. We've known about this for a long, long time, David. Do you believe, in your opinion, given the fact that you're involved in these markets, are the gold markets manipulated by financial services out there?
Well, I think you do see manipulation from time to time, and manipulation can be very effective in the short run, but the long-term trends ultimately trump any short-term intervention in the market. And I mean, if I've heard that argument, listen, silver's suppressed, gold is suppressed.
Right.
It's hard, though, to argue that the last 10 to 12 years has been a successful manipulation scheme with 500 to 700% returns. Whoever was trying to manipulate failed utterly. Now, again, there are points in time where if the market is running out of buyers and it looks like you could see the price trip up, yes, you can see downside pressure. Yes, in the short run, you can see short sellers come in and drive the price down even lower. That kind of behavior is normal in the short run, but ultimately doesn't trump the long-term trends. I think, two things that would stand out to me. In the last 2 months, two of the largest bond fund managers. You were suggesting gold and silver, a canary in the gold mine.
Yeah, canary
in the coal mine.
Yeah.
For future inflation. You've got Jeffrey Gundlach with Double Line Capital out of California, one of the largest bond fund managers, successful bond fund managers in the world, saying, I like silver. You don't see fixed income managers, folks who have and manage bond fund portfolios, suggesting real assets, except in the case where inflation is around the corner. Bill Gross, the manager of the largest bond fund
in the
world.
PIMCO, right?
PIMCO, exactly, the real returns. Okay, so Bill Gross in the most recent roundtable discussion with Barron's, what was his number one pick for 2013? Gold. I mean, again, this is fascinating to me. We manage assets across all asset classes. We also have a precious metals brokerage firm, have had for 40 years. But when you see fixed income asset managers saying you need to own real things, the only time that they suggest that is when they see inflation already in the pipeline.
When they already see it, okay, because you would think that bond people would be talking bonds. Now, that brings me up to another question. Are bonds in a bubble, or is government debt in a bubble at this point? What do you say?
It is in a bubble. The question is, how much further can it go? I mean, you remember the conversation in 1996 of irrational exuberance in the stock market. That didn't prevent stocks from doubling from there. What you have is an arbitrary and a completely controlled market in the bond market today. Who's the largest buyer of treasuries?
The Federal Reserve, yeah.
Right. So, I mean, when you have sort of direct monetization of debt, this is the 40 and 45 billion, respectively, of mortgage-backed securities and treasuries, you don't have price discovery, you don't have real prices, you don't know what the value of those bonds would be otherwise if there wasn't direct manipulation of the market. So are we in a bond bubble? Oh, absolutely. But how much farther can it go? I mean, it
can go a lot farther. Yeah.
Yeah. Who owns the printing press? They can continue to buy because they have the printing press.
All right. So, David, what about the issues with stocks? Ben Bernanke has made it clear that he's going to continue to QE, pedal to the metal. We're going to keep flooding the market with liquidity, which will benefit stocks. Now, are you saying that you don't buy stocks and that you just go all into gold, or are you just talking about a good mix like hedging in either direction? Because it would be a shame not to catch a wave right now, because it seems like this is baked in the cake. This is what Bernanke is saying. Hey, we're going to goose the stock market. We're going to do whatever it takes to goose the stock market.
Well, it's a great question, and yes, you have to take a balanced approach when you're investing because no one has a crystal ball and can guarantee future outcomes. But I think one of the things that we do know from some very rigorous studies, Shiller, who put together the Shiller Home Index.
Yeah, the real estate index, yeah.
Right. He's also put together a number of other numbers. I mean, this is what academics do, and he happens to be an academic at Yale. What he calls the Shiller PE is what others have actually called the cyclically adjusted price-earnings multiple. This is going to seem very obtuse, but just hang in there.
All right.
The normal PE would say, this is a reasonable time to be buying equities. When you look at a 10-year rolling average and adjust for inflation, that is the Shiller PE, we're at 23 on that index.
That's very high, isn't it?
It's high, and what it implies is that over the next 10 years, someone who's buying the S&P 500 today can expect, on the generous side, on average, between 2 and 3% returns. So the next 10 years, that's the promise that you have. 1 decade from now, you'll be about 30% ahead of where you are today. Now, that's not factoring in a real rate of return. In other words, you have to suck out taxes, you have to suck out inflation. But just your nominal rate of return, when you're buying stocks at a cyclically adjusted price-earnings multiple of 23, the way that pencils out is you can expect 2 to 3% returns. Now, to your question, Bill, we could have 20% this year and then negative returns the following year. I mean, the way that you average out that 2 to 3%, yes, we have QE in the pipeline. Yes, we have an accommodative Fed. Yes, he's going to try to continue to goose asset prices. But are you buying a value today? At least according to Shiller and the Shiller PE, absolutely not.
Yeah, at 23 price-earnings ratio, that means that you're risking you're paying $23 to get $1 worth of return, right?
Well, but this is where we've seen it higher. We saw it higher in 1968, just before we went into a bear market for 16, 20 years.
Yeah.
We saw it higher in 1929. It was actually a PE of 32, the cyclically adjusted price-earnings multiple of 32. Well, 29, I have to tell you, it did not end well as we headed into 30, 31, and 32.
Sure.
We saw it higher in the year 2000. It was actually close to 40 in the year 2000. But, I mean, again, what happened in 2001?
Yeah.
When you get to these sort of nosebleed levels, it's not good times and better times immediately ahead. It's struggle and challenge immediately ahead. Our view is that there's greater risk in the marketplace than is represented in current pricing. And again, it's you can look at the stock market and say we're here in large part because of central bank activity.
So, David, what you are saying, bottom line, then, is you are not drinking Ben's Kool-Aid, or at least not letting yourself intoxicate on it. Fair enough?
That's very fair. That's very fair.
All right.
I mean, you have to take a balanced approach. I mean, but I would, for those who are 100% equities, no.
Okay.
I mean, that's where I would say, if you had 1/3 in growth and income-oriented, equity and bond-oriented investments, 1/3 in cash, and 1/3 in precious metals, some sort of a balance between those two. I mean, in 1/3 in cash, asset managers today would say that's crazy. You've got to be all in. This is a growth-oriented environment. You can't miss the opportunity liquidity. Well, listen, being all in anything implies that you have more information than you actually do. It speaks to pride, it speaks to hubris, and it speaks to a demise immediately to follow. No one has the future figured out.
All right, David, I appreciate your take on this because I've had some questions on this precious metal because you listen to talk radio and it's always about buy gold, buy gold, buy gold, and they've been saying that when gold was going up, they were saying it when gold was going down. There's a part of me going like, oh, come on, what else is going on here? So, what can people find out when they go to McIlvaney.com, or do you have any phone numbers, anything like that? I appreciate your time.
Yeah, well, I think one of the things they can find out is not only how to buy gold, but how to sell it as well. And I mean, this is important. When you're in a bull market, there's a time to buy and there's a time to sell. If you don't have a reduction strategy, an exit strategy, it makes no sense to buy in the first place. And I think that's probably the difference between us and anyone else in our industry, is that we understand both sides of this. And we've been around, we're heading into our fifth decade. We know what bull and bear markets look like. And this one's, frankly, long in the tooth. If we have another 3 to 5 years of growth, that's probably on the generous side. Be working with someone that can help you exit as well as enter the market. You can find us at McIlvaney.com. It's McAlvany.com. And I would suggest people get to know us by watching our most recent DVD series. We had a 20-minute clip on Europe, on Asia, and then a third, which we called An American Reckoning. If you want a physical copy of the DVD, we'll send it out complimentary, or you can watch it online. Go to YouTube. All of that you can find linked at McIlvaney.com.
David McIlvaney, we appreciate your take on these issues this morning. Find a quick question here. How do you think this Cyprus bank robbery situation will be solved, in your opinion, your financial opinion?
The challenge here is to convince depositors throughout peripheral Europe that it won't and can't happen to them. It doesn't matter if they do or don't implement this levy on bank deposits. The fact that the EU, the Eurozone ministers, and the IMF are holding them at the end of a gun saying, if you want $10 billion in bailouts, you're going to do this. The Parliament may say, emphatically and forever, no, we're not going to. But the fact that it was even proposed introduces a new insecurity into bank depositors' minds that they haven't experienced probably since the 1930s, where they thought, maybe my assets are at jeopardy. I think that's the lesson to learn here, is that bureaucrats don't view your private property as your private property. And that's a very scary realization in a very frail financial and economic environment. I think it was very misguided to suggest it. I realize there's very few options in terms of the bank bailouts, and Cyprus is in a very difficult position. But I think the bigger issue in the Eurozone today is try to convince Spanish, Italian, French depositors that the same thing couldn't happen to them.
What about us?
Well, that's a very good question. I think we're a long way off from something like that being proposed. But again, you look at the mind of a bureaucrat who prioritizes the many over the few, and you have to understand that as a private individual with private property, if the greater good is served, then confiscation of your wealth, a wealth tax, may be in the offing. And again, I think we're still years away from that, 2-3 years away from really being under the gun and in those sorts of circumstances in the United States. But I think it is a wake-up call for everyone who says, no, it's guaranteed, it is sacrosanct, no one will touch this. Well, they won't touch it until they have to, and then you realize that you are expendable. Your assets, your resources are expendable if they serve the quote-unquote greater good.
The greater good, where tyranny always comes to the forefront, right?
That's right.
David McIlvaney, McIlvaney Financial Group, McIlvaney.com. We'll link to it all on our blog page this morning, too. David, thanks for your thoughts this morning.
Thank you, Bill.